Hi, everyone. This is Dr. Gregory, and this is Accounting 667 Advanced Audit. We're going to be going over Chapter 8 in two parts. So Part 1 will be Modules 1 and 2. Chapter 8 is about fraud detection, red flags, and targeted risk assessment. So let's talk about Module 1, Corporate Governance and Fraud. As we can see, there's all kinds of things that can go on with corporate governance and fraud. We have external issues such as bribery and extortion. We have customers that can affect corporate governance in the form of demanding or receiving kickbacks, money laundering, warranty and exchange theft, and just straight out theft on its own. We can witness fraud through our competitors in price fixing or collusion. We have board issues. Boards can be involved in insider trading if it's publicly held, conflicts of interest, stock option manipulation. Suppliers could be giving us kickbacks on purchases, overcharging, substituting goods and products for other goods and products. Employees can steal from us. They can misappropriate assets. They can be ghost employees that don't even exist. They could be fraudulently completing timesheets. And management. Management can affect fraud in so many different ways. Through asset overvaluation, expense manipulation, theft, money laundering, overriding of internal controls. So you see, we have a lot of issues that we have to contend with when we're talking about how we govern and protect our companies from fraud, because it can happen anywhere. In finance classes that I've taken, one of the things that always comes out in my finance classes, and I got my master's in finance, was the purpose of a company, especially a publicly held company, was to maximize shareholders' wealth. Well, it really is that management's responsibility is just to maximize shareholders' wealth, or perhaps it's more organic with the company, where they have to ensure that strategic objectives and performance objectives are met, developing and implementing their long-term and short-term strategies, protecting the assets of the company and the resources of the companies from all the stuff that could be going on, adopting sound internal controls to protect the company, and complying with all of those regulatory and taxing agencies that we have to deal with all the time. So really, management's responsibility, all of this encapsulates a strong mission, vision, and goal. And that's where we should be focusing instead of just, in my opinion, on shareholder wealth. Now, there's this risk of management override and collusion. I'm going to post the report to the nations, the ACFE report to the nations, which has got some really, really great statistics in it on risk of management override and risk of collusion that goes on in organizations. But, you know, you could take a look and find that the current internal controls don't always ensure management cannot override controls. And they could do it in a couple of ways. They could have unauthorized access to the system and do the overrides themselves, or they could coerce another employee or collude with another employee to have that done, who do have those administrative rights. So there's things that we can do to help look at and determine if there are unusual things going on in the books and records of your company. One, we look at the journal entries and any of those other adjustments and make sure that they're always supported by proper documentation. We could do Review and rationale of accounting estimates. One of the things we find is accounting estimates are out there as journal entries, but we always don't see the rationale behind them. And in audits that I've performed, and I've gone to some companies and said, well, how did you come out with your allowance for doubtful account estimate? Some of them have just said, well, the boss just tells me to post X. Well, that's not really a rationale. You want to look at some historical information. You want something in writing as to how they came up with that rationale. And then you want to go and test it against what's really going on. So if they're being told to use 10% as the allowance for doubtful accounts, but they're writing off 15% or 20% every year of their accounts receivable, then you have to look at it and say, well, maybe they are underestimating the allowance for doubtful accounts because that's a contra asset account, and that reduces the amount of accounts receivable, and we want our assets to look good. So you want to take a look at that and see, is there rationale behind it? Look for unusual one-time transactions or unusually high transactions in accounts that normally don't have high transaction amounts in it. Also, look at your miscellaneous accounts, miscellaneous revenue, miscellaneous expenses. It could be that they have just erroneously posted something to one of those accounts, or it could be that they're trying to cover up expenses that should be reported in those other accounts. Now, when we think about perpetrators, particularly in management, they're, according to the ACFE, they're likely to be older and educated males. But now we're starting to see the field widen, and women are now getting involved in this. So it's equal opportunity. Most of the management override comes from senior management because they are looking at the whole of the financial statements, and they know where they need to manipulate those numbers. It's more likely through corruption or financial statement fraud. And what we find is that the higher internal controls you have, or the more internal controls you have, there's a lower risk of management override. Now, collusion tends to be younger, less likely to exhibit the behaviors of fraud. They may have an unusual close relationship with your vendors, suppliers, customers. Sometimes that's something you want to look for. Look for employees that talk about getting gifts from suppliers or vendors. I had an employee once that received a electronic stapler. Not a big deal, but we were a very small company. And I asked him, where did you get that? Well, our supplier gave it to us. And I said, well, why? Because I asked for it. Well, do you think that something's going to be asked for where there's not something expected to be received at some point in time? I had that employee return the stapler, thanking the supplier. Collusive fraud between two or more people is usually shorter in duration because they're harder to stay quiet, but we find that they are much larger dollar losses, and they're most likely to be discovered by a tip or complaint. And we get those all the time when we're investigating frauds. Somebody will call us up and say, hey, so-and-so just got X. I think something's going on. Or employees are jealous. Now, the role of the external auditor in all this is to provide reasonable assurance that financial statements are free from material misstatement. Now, let's think about that. Let's break this sentence out. Reasonable assurance. That doesn't mean 100%. And you can never achieve 100% because everyday transactions are happening. So every day you would have to audit 100% of everything to stay on top of it. And that's impossible. Now, management will tell you or will make the presumption that forensic accountants and auditors are here to eliminate fraud, and that's not true. We are just here to provide a reasonable assurance that there isn't a material misstatement. Now, there's another word that we have to think about. FASB 2 identifies material as based on professional skepticism and judgment. That leaves a lot of room. And one of the roles you will play is when you are assessing risk and determine materiality, you're going to have a rationale behind it. You're going to look at the past. You're going to look at economic factors, internal and external factors to the organization to determine what materiality may be, and then apply logic and reasoning when you are developing your substantive tests behind it. One area that came out of the Sarbanes-Oxley Act, and we will get into this later, is management is now responsible that they must put in writing for the financial reporting processes and outputs. They are responsible for the financial statements, not the auditors. Before Sarbanes-Oxley, if a company was in trouble, they would merely blame the auditors, because oftentimes auditors would come into companies and help post maybe year-end adjustments, make some corrective entries. So if something went wrong, it was always the auditor's fault. But that changed after the Sarbanes-Oxley Act of 2002. Now, there are 8 steps to consider when we're looking at fraud in a financial statement audit. This is AU Section 316. Its source was the old SAS 99, detecting fraud in financial statements. First, we want to start off with staff discussions. What's going on in the company? Listening to employees, listening to management, asking questions. And from there, you find the information, or you hear of the information needed to identify risk. For example, if staff are complaining that they're working a lot of hours because they are required to meet certain revenue goals, that might be a risk to the organization of financial fraud if they aren't making those percentage revenue goals that the company wants. So you want to identify that as a risk. Then you want to assess the risks and associate them or align them to the possible schemes in internal control, such as manipulation of the financial statements, maybe over-recording revenue to make that percentage. Then once we assess it and look at the results of what that risk could be, we look for the information and the evidence. And evidence is just whatever there is as far as data that can support or refute that assertion. So we evaluate the audit evidence. If it comes to the point where we either support it or refute it, either way, we have to communicate that. And we can communicate it verbally and or document it. So those are the 8 steps that we kind of have to go through when we're considering fraud in financial statement audits. Now, these 8 steps go through a litany of different risks. It's not one risk to the organization. It could be a risk that there are inadequate policies in place, or inadequate operating procedures, or inadequate segregation of duties, or risk of cash loss. So for each account and each control effort, We need to consider those 8 steps when developing and documenting the risk of fraud to a company. Let's dive in a little bit about materiality. Materiality in most audits is a percentage, 5%, 10%. 10%, if we find errors greater than 10% of the total assets of the organization, we're going to consider that material. Or if we have over 5% of accounts payable that contain some type of error that needs correction, we might consider that material. So material is just considered the magnitude of the omission or the error irregularity involved. And we have to apply our judgment based on our knowledge of the industry and any other relevant information. For example, the risk I said earlier about meeting a certain percentage of sales. That could be a risk that we would have to look at and see if we could determine materiality, which could cause the financial statements to be misstated. Now, it's relative to the size of the company. A $50,000 materiality level on accounts payable may be material to a $10 million company, but it might not be material to a $100 million company. So you have to put the company size in perspective. Now, one of the things we have to be aware of is illegal acts have no materiality. If we see, for example, the FCPA rear its ugly head in a bidding with a foreign government, when the Foreign Corrupt Practices Act comes into play, 1 cent is material. Anything is material to that because that is a pure illegal act. There isn't a threshold of that. Now, materiality is usually set by account or account classification, and it's not static. Every year, auditors need to review that materiality level because data goes up and down, results go up and down. A materiality level of 10% might be satisfactory for revenue in year 1, but if revenue decreases or increases, we might have to change that materiality level to be more appropriate. Now, boards of directors and audit committees, finance committees, accounting committees, they're called different things, are here to oversee management. They are the fiduciary steward of the financial activities, and they work in tandem with both internal auditors and external auditors. So internal auditors, in the past, we see that internal auditors are often associated with maybe the CEO, but in reality, they should be reporting straight to the board. They should have no alliance to any senior key management staff or below. They should be autonomous to that, but it's often the case that they report to the CEO or the CFO. That can create some conflicts of interest. The external auditors should only be reporting to the boards of directors. Now, oftentimes they have a liaison, usually the CFO or the controller of an organization is the liaison between the board and the auditors to help guide them, to answer questions, to ensure that documents are ready for them. But in the end, they should be reporting their findings straight to the board of directors and the audit committee. Module 2 talks a lot about fraud detection, and it's a really challenging task. You have to put your hat on and think like a fraudster thinks. And that could be difficult because frauds are vast and complex. As an auditor, you're only looking at that reasonable assurance. Remember, not 100%, just a reasonable assurance that the financial statements are free from material misstatements. Does that mean that there might be some minor irregularities and minor errors in there? Sure, there are going to be. And you're probably going to recommend to the board, to the audit committee, or to management that they make some corrective action in order to clean up some of these minor things. But they have the option of not having to take action if it doesn't materially affect the outcome of the financial statement. Now, the difference between an auditor and a fraud examiner is that while auditors are just opining over the overall context of the financial statements and whether or not they are free of material misstatements, fraud examiners take their position much deeper. They go beyond looking at documents and transactions. So normally as an auditor, we're looking to see that every transaction has source documents on them. Fraud examiners will go deeper and they look to examine the authenticity of the information. Auditors will do it to a point, but again, auditors are looking at a cost benefit of how much work they do in order to arrive at their conclusions and their opinions. Fraud examiners go much deeper, but the positions may intertwine. You may start out as the auditing something and then find that you have to look at the authentication of documents and transactions in events of a company. Now, in fraud detection, you have to know where to look, which means you have to have a very solid foundational knowledge and skill, both in fraud in general and in the industry that you're working in, because every industry is going to have different risks. Every industry is going to have different events and transactions, and every industry is going to have different ways of conducting fraud. For example, companies that have a lot of contracts or they bid on different contracts, they may be more involved perhaps in bribery and corruption than perhaps a nonprofit museum would. So you have to understand the industry that you're working in. Another thing you have to do is you have to have this mindset of professional skepticism, and it's the questioning mind. You kind of have to look at things from that fraudulent point of view in order to get that mindset of, is this real or is this fake in the transactions? Is this real revenue? Is it fake revenue? And when we do that, we sometimes can get a little jaded on our perceptions of things. Usually as fraud examiners and fraud detectors, we come in with that mind that something's going wrong. We just have to find it. So we not only look at the financial documents themselves, the sources of information, the statements, the transactions, we also look at red flags in people. So we look for red flags in the data, unusual transactions, high balances, questioning activity, and we look at the people in the organization as well to see, do they exhibit any type of behaviors that could lead us down that path of fraud? And then we have to develop targeted risk assessments for each one of these things that we see. Now, the ACFE has tons of products, including CPE, general information, books. I've got a number of books that I use regularly as resources for not only classes, but my work. So go into the acfe.com. If you're not a member and you're interested in getting into this line of business or this industry, you can join a student membership at a lower cost and get access to self-study courses, seminars, conferences. There's a CPE exam prep course that you can take to get your certified fraud examiner's license. And the books are third-party books, but they're authored by experts in various industries: healthcare, finance, banking, general studies, looking at behavioral tactics, looking at how to do investigative skills. So this is a really great resource, and I would recommend that you bookmark this site on your computer for future referencing. Now, as we've said before, when you're going in to assess a fraud, one, you have to understand the business and the industry, because different frauds manifest differently depending on the industry. Now, the nice thing is the AICPA at aicpa.org has what they call risk alerts, which are pamphlets that and reports that they send out every year on different industries. So if you want to work in the casino industry, they have risk alerts about what is happening, what is going on, what are auditors finding in the casino industry that can give you a heads up when you're approaching the assessment of an audit. Now, you have to understand the internal control environment in that business. What are some of the policies that are going on in that business? How are they training their employees? How are they doing hiring checks? Do they have tip lines? Do they have complaints? Those things can help you understand if management, the tone at the top, is actually looking out for the best interest of that company. Here are some red flags. There are many, many more in your text, but here are just a few that I found that are usually you can seek out fraud if you're looking at these red flags. On the operating side, on the business side, do they have supporting documentation? Do you see general ledger entries that have no supporting documents? Do you see facsimile copies or photocopies of invoices instead of the actual invoice itself? Do the transactions appear reasonable and rational to the account? You have to look at that. Do they appear like it, or are there unusual transactions going on that would not necessarily be classified in that account? Does the event, the transaction, make sense in the totality of the business industry? If you are an airplane company, are you buying airplane tires or are you buying regular tires? And are they being classified as vehicle tires or airplane tires? So look for things that make sense or don't make sense in the industry. And does the transaction just feel or look suspicious? I was working on a review for an agency in the federal government with another team, and we were looking at bills coming in from real estate management companies. And what we were finding were bills that had that were paid. They had an address of the real estate office that the company paid, but the logo was clip art. Now, do you think if a company who's a property management company is sending out invoices using basic clip art you could find on your Word document, that didn't make sense? And we kept seeing a number of these coming from the same geographical area. And we looked up the homes, found out that the homes were not owned by those government agencies. Looked them up on and found out that those homes were actually owned by people of the property management company. So they were sending false invoices using clip art to a company to an agency that oversaw the management of a lot of homes that the agency had, but they weren't tracking it. And when we investigated it and we found that these were false invoices, management came back and said, we have too many homes we're trying to monitor. We have to pay these bills in 5 days. We were just shoving the payments out the door. So look for things that look odd. Clip art was odd. Now, on the other side, if we are looking at people behaviors, sometimes you just have to sit and listen. As a fraud examiner, even though sometimes we're put in an office or we're put in a conference room to work on our work, we oftentimes have to talk to employees, just as a matter of understanding processes and procedures. Do people look like they are living outside of their means? Do you have a entry-level employee wearing designer clothes, driving flashy cars? It's something that you have to be aware of, which means you need to keep not only your eyes, but your ears to the ground. Do you hear other people talking about how jealous people are? Are you looking at sudden shifts in attendance or attitude? Do you hear that from employees? Well, Sally, up until a couple of months ago, was always so joyful and helpful, and now she's kind of grouchy and she's hard to talk to, and she doesn't really answer questions for you, or she doesn't have time to talk to you. Changes in attitude, changes in behavior. One thing I do when I go in to do a fraud examination, and oftentimes when I'm doing an audit, one of the first things I want to do is look at the attendance. Who hasn't taken a vacation? Or who is all of a sudden taking a lot of vacation or a lot of leave? You might have somebody that's got perhaps some addiction issues. Finally, that lack of vacation leave, that could be a red flag. People who don't allow anyone to work on their desk while they're gone, that could be a red flag. It could be that someone's hiding or concealing something that they don't want other people to see. How many times have you seen somebody going on vacation and they say, just leave everything. I'll get to it when I get back. Well, that might be very helpful to everybody else. Phew, I don't have to do that person's work. But at the same time, that could be a behavioral red flag. Again, here's some anomalies. Unusual items. Missing transactions. Checks out of sequence. Cash transactions where there's a check or credit card that's usually used. Increased waste and scrap. That could be a training issue. Excessive late charges. It could be that someone, again, needs training. They may not know how to do their job. There could be missing documentation. When you're doing your ratio analysis to determine your risk factors, you might be seeing some unusual ratios that don't match either to what they've done in the past or to industry benchmarks. There could be more errors that recall reconciliation issues and duplicate payments. Those are all anomalies. It doesn't mean that there's something fraudulent going on. It could be a lack of training. It could be that you have a new employee that just needs a little bit more help. It could be you have a disorganized filing system, things like that. Those aren't necessarily fraud, but they are anomalies to look into. Now, when we look at internal control irregularities and weaknesses, we could be looking at one of any of these or a combination of the internal controls. And we know that the internal controls are the adequate separation of duties, don't have one person handle a lot of the same process. We have proper transaction authorizations. We have adequate documents and records. There's that documentation again. We lock up and have physical control and safekeeping of our assets. and our records, and we have monitoring, both internal and external. Some of the issues that could come up are a lack of any of these internal controls. It could be that there's overriding permissions. It could be that there's a lack of segregation of duties or improper authorization. I worked on a fraud at a bank. We knew the person had stolen the money from these bank accounts. The problem was that that person had shared their password with others in the office. So all we could see was the user, which was that person. But then when we went to investigate, it was somebody else who used that person's password. And so we couldn't put the blame on that person because they had shared their passwords. Do we have inadequate accounting systems? Is your accounting system antiquated? Is it no longer fitting the needs of your organization? Are there no methods to report suspected fraud? There should be a hotline, an anonymous hotline. Does the board of directors and or senior management talk about how much they trust the employees? We trust them because this is a family organization. The word trust can be an abdication of fiduciary oversight. And remember, that's what the board is. They are the fiduciary stewards of this organization. And sometimes they say, oh, I don't need to look at that audit report. I trust my employees are doing their job. So watch for things like that. Watch for these little issues that came up. Okay, that's the end of part 1. If you have questions, please post them to the class questions for the good of the class. You can send me a Halo message, or you can schedule a 15, 30, or 60-minute meeting with me on Calendly. And finally, one does not simply address risk without a good framework. Do your planning, understand your industry, and know your business, and you'll develop a good framework. Have a great week, and I'll see you in the classroom.